Hi, in this video, we will discuss some of the basic elements in market microstructure. Market microstructure is a technical term used to indicate the inner workings of financial markets. Usually, how prices are formed, how the markets operate, transaction types, order types, rules of trading, traders' behavior, etc. Some of the basic elements we will cover in this video are different order types, bid and asking price, and some innovations in trading strategies. But first, bid, ask, and spread. Before getting into bid and ask, I would encourage you to switch your thinking mindset from a normal ordinary market to an auction-based market. An auction market is competitive. People are competing with each other to get something. In financial market, the same thing happens. The buyers of a stock are competing to get a certain stock, and the sellers are competing to get the cash. Of course, the sellers are competing to get as much cash as possible, as much bucks as possible, and the buyers are trying to pay as less as possible. This mechanism is reflected beautifully in the bid and ask process. So, what is a bid price? Bid, or the bidding price, is the highest rate or the highest quotation of price that a buyer or a bidder is ready to pay for a stock. An ask, or an asking price, or an offer price is the lowest amount, lowest dollar amount that a seller is willing to accept for that same stock. The top bid and the top ask are never usually the same price. In fact, the difference between the top bid and top ask price are called the spread, or the bid-ask spread. Let's take a look at an example. In the image shown here, we are looking at the queue of the 5 best bid and ask prices for a stock called AT. The bid prices are in blue, and the asking prices are in red. The best bid quotation is at 30 cents, and the best asking price is at 30.5 cents. Or 30.5 cents. So, if you want to buy the stock AT right now, the lowest amount you can buy it at is 30.5 cents. Conversely, if you want to sell, if you are an existing shareholder of AT and you want to liquidate, the highest amount that you can sell right now is at 30 cents. And the difference between these two best quotations is the spread, or the bid-ask spread. And the spread here is half a cent. This spread is an excellent indicator of the liquidity of a stock. For a highly liquid stock or bond in any financial instrument, the spread is very low. On the other hand, illiquid financial instruments show very large spread. That indicates there are not many buyers or not many sellers available to take positions in the market. I will give you a real-life parallel for this. Even if you don't have experience in trading stocks or participating in financial markets, I'm certain that you have seen money changers in the airports or malls or in other places. These money changers quote one rate if you want to buy a particular currency, and another if you want to sell. If you want to buy, you always have to buy at a higher rate. That is the money changer's asking rate. Now, if you're selling, you always receive the lower rate. That is the money changer's bidding rate for your currency. So you probably have some experiences in dealing in this bid and ask process yourself, but probably not in a financial market context. Some more examples of this are available to you on screen. Next, we move on to order types. The easiest type of order to understand is the market order. In this kind of an order, the trade takes place in the ongoing market price. For example, let's say you are a broker. Your client messages you that you want to buy a stock at a market price, or it's a market order. That means he or she will buy the stock at a price quoted at the nearest asking price. So a market order buy is executed at the topmost asking price. On the other hand, if your client tells you to sell at a market rate, you will sell at the nearest bid quotation. I repeat, a sell market order will be executed at the best bid quotation, best bidding price. It is necessary for you to remember that market orders will not necessarily be executed at the last traded price. The last traded price is only a report that tells you that the previous buyer and seller agreed at a certain point or a certain price. It is no guarantee that the future prices or the future trades will happen at the exact same rate. It is only an indication. So, at what price that order will be executed will depend on the bid-ask order book, also called the liquidity of the order book. In other words, the queue position of buyers and sellers. Market orders are very common for smaller or retail or unsophisticated investors who simply want to buy or sell a stock quickly without any delay. The main advantage of this order is that you're guaranteed that you will be able to buy or sell the stock you are looking at. You're just not sure at what price that transaction will take place in. Another type of order, usually used by more sophisticated traders and professional investors, is called a price contingent order. It is more commonly known as the limit order in the practitioners community. In this kind of an order, the buyer or the seller specifies at what price they want their trade to be executed. So, let's say you want to buy 1,000 shares of the Ford Motor Company. The last traded price was at $5, but you don't want to pay that much. Let's say you are interested to buy Ford at $4.95. So, your broker can then set a pending order at $4.95, which will not immediately execute because the market is executing orders at or around $5. So this means that if the price at some point falls down to $4.95, the trade will be executed. In other words, a situation must arise where other investors would be willing to sell you 1,000 shares of Ford at $4.95. If this happens, you get your 1,000 shares, and we will be able to say that your order has been filled or fulfilled. But if it doesn't happen, the trade will not execute. Similarly, for the selling scenario, if you set a limit order at $5.05, it will only execute if the price rises to that level. So if the price does not go up to $5.05, nobody will touch your shares. Your shares will remain unsold. So that's a brief introduction on bid and ask and their spread and different types of orders. Now, all the basic elements discussed so far in this video have been in practice for a number of years. In fact, for hundreds of years. However, in recent times, there have been many innovations. Noticeable among them are algorithmic or robotic trading, high-frequency trading, and dark pools. These are advanced topics, and as such, I will not go into too much details. But I still want to introduce you to some of these. Firstly, algorithmic trading. What is an algorithm? Well, simply put, it is a rule-based workflow. Rules such as, if X happens, what do we do? If X does not happen, then what? You are probably familiar with this kind of a workflow in other disciplines. But in the trading world, computer programs have been written based on such rule-based strategies to make decisions automatically depending on different market situations. So, algorithmic trading makes use of complex formulas combined with mathematical models and human intervention and oversight to make trading decisions to buy or sell shares or bonds or other securities in an exchange. This originally started in the mid-1970s, but has become extremely common in the advanced markets around the world right now. And in fact, it is estimated that way more than half of all the equity trades in the North American markets are fully computerized. That means robots are making those trades, not individual traders like you and me. This is very useful for those institutions because it takes away the need for constantly monitoring the market at all times. You can say it is automation at its finest. Another term closely associated with algorithmic trading is HFT or high-frequency trading. It is practically a subclass of algorithmic trading, but with some extra specialties. There are some key elements that differentiate high-frequency trading from robotic trading. One is high-speed trade execution, extremely large number of transactions, and a very short investment horizon. And by very short, we're meaning seconds and maybe even milliseconds or microseconds. So you know that in normal trading strategies, we try to make profit by chasing a big gap. Buy low, sell high, but how high? Well, ideally speaking, buy as low as possible and sell as high as possible. That's the way to make a large profit. And for those profits to materialize, we probably have to wait a long time, months if not years. Now, in the high-frequency trading philosophy, the idea is, why do we have to wait for that long? Most of the price changes are very small. So why not exploit those small changes in a rule-based manner and try to make small profits? And if you make those small profits by engaging in many transactions, you eventually get the same result as those people who invest over a long horizon. Small profits multiplied by many transactions is large profit. As a result, very smart people went on to write computer codes to profit from very small price fluctuations. So modern programs, trading programs, are able to scan different markets and exchanges, even spread across different continents. Let's say the New York exchanges, Chicago exchanges versus the ones in London and mainland Europe, such as the DAX in Germany and CAC in France. They are able to study and look for price discrepancies of the same asset across different markets and exploit those changes. By making this process automated, they can find a lot more trading opportunities that we humans are capable of. And they're also able to engage in very fast arbitrage opportunities. So arbitrage, simply put, is discrepancies in prices across different geographical locations. So that concludes a brief introduction to high-frequency trading. On to the dark pool. Now, the name starts with dark. A dark pool sounds quite scary, but it isn't really. A dark pool is just a private exchange or a private venue which facilitates transactions of different financial instruments. It is different from a normal public exchange because there is no visible order book and the trades are not visible to the general public. In fact, this anonymity, the darkness and the secrecy and the paranoia over privacy is what attracts large institutions and funds to the dark pools to trade there. A lot of the times, if these institutions and funds reveal their intentions publicly, what do you think would happen? Imagine Warren Buffett and Coca-Cola. Warren Buffett's firm, Berkshire Hathaway, owns about 10% of Coke. If one day, for some reason, Warren Buffett decided to sell off his position, what would happen? The public would automatically panic within an instant. Everybody would rush to sell Coca-Cola, which would then drag the price down. How can Warren Buffett offload his position then? His stake in Coke is about $10 billion and probably more than that now. This inability to liquidate his position would lead to a huge loss for his firm, for his fund, and their shareholders, because they simply would not be able to offload. Other people would get the hint and rush to the market to sell their position in the fear that Warren Buffett is getting out of Coke. So, privacy is of extreme importance to the big fishes in the market, which is why they like trading in the dark pools. So, using dark pool allows financial institutions to place orders and execute trades without publicly letting their intentions be known, especially if they're interested in engaging in very large transactions. We're talking millions and billions of dollars worth of transactions or assets changing hands, because they realize that if that information leaks or if their identity is revealed, that could have a negative impact on their trade even before they get a chance to execute. This is why a large portion of the trades, especially the block or large-scale transaction trades that takes place in North America, are in the form of dark pool trades. So that's it for this video. I will see you in the next one. Bye.